Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, March 29th, and then we'll see how things look for Thursday, March 30th. We had a really solid up day. Most of the gains came right at the open. The futures were pretty strong during the night. After we gapped higher, we drifted sideways. Later on in the day, we did see some more strength, and we closed pretty much at the high for the session. Many of our charts are showing improvement, but there's still some warning signs, and you'll find as I go through these videos, when we're going up, I'm looking for reasons why we could go down. When we're going down, I'm looking for reasons why we could go up. First, to take care of a couple of things, please be advised from April 22nd through May 11th, I will be traveling. My intention is to post videos. I'll do the best that I can with all of that. Also, I've recently launched a podcast on YouTube, but it's a duplicate of the videos that you're watching right now. There is a PDF that's available each day. It's in the description, so please feel free to download that if you feel that looking at the charts and slides that I use would be helpful. I'm trying to put a little bit more focus on the private Facebook group that I have. There's only a few members in there, and we would mainly talk amongst ourselves. Well, some more people are starting to join, and people are wondering, is this really an active group? I'm going to try to start posting some charts and things that I run across just to spark some kind of conversation. And if you want to join that, please feel free to do so. Let's go back and talk about what happened. Right at the open, we had a gap higher open with prices going above R1 at 39.83. They also went above R2 at 39.95, pretty much right out of the gate. As the day went on, we drifted sideways, but we held on to the gains. There wasn't any real serious selling that came into the market. We rose later in the day to close above R3 at 40.23. We were up 1.42%, but this is a concern, below average volume. We've seen a number of up days now where the volume has been decreasing, and that is a concern. The technicals are looking a lot more positive. We're positive in the short term. We're getting more positive in the intermediate term, and even some of our long-term charts are starting to show some improvement, and I'll show those to you. But the market's really fixated on this inflation and interest rate scenario, as well as is there going to be more information about this whole banking problem that's been going on, and is that going to influence the market? Here's the intraday chart showing how we gapped above R1 and R2, then drifted sideways for a lot of the day, and then later in the day we saw some more buying coming in, and actually were able to get above R3 and close just a little bit above R3 for the session. Here's large cap growth versus value. This was a little bit disappointing, and I'll show you on the end of day numbers that we have where they were both up, but growth did underperform value. You can see that on this next chart. Growth was up 1.31%, but value did better. The same is true with the mid caps, where growth did outperform value with the small caps. Here's the intraday chart of the SPY. After we closed in Wednesday's session, we drifted a little bit higher. That's this pink area. And then things really shot up in the overnight market, and we were able to hold on to those gains. We took those into the open, saw the nice advance during the day. Right now, we're drifting sideways to slightly lower. So what are some comments that we can make? The S&P was able to regain its 50-period moving average at 4,014. That's very positive on an intermediate term basis. Growth did underperform value for the large caps and the mid caps. That's a little warning sign. Volume continues to be below average, and I've been pointing that out in each day's video, but as we're going up, and especially when we saw a pretty strong up day, to see below average volume is a concern. On a short-term basis, we have our Stochc RSI. That had already been extreme positive. Well, now we have stochastics in that mix as well. Intermediate term, we have the McClellan Oscillator, the PMO study, the CCI 14 and 20 that are now getting extreme. Now, we can look at this two ways. We can say maybe we're getting a little overextended to the upside, or we can say, look at all these indicators. They're telling us the momentum is going up. So there's a positive side and a negative side. The dollar was up and interest rates were virtually unchanged on the day. We still have the 30 to the 5 that's back to being normal, but all of our other yield curves are inverted. Sentiment is still negative. We did tick up with the up day. We're at 40 right now where we had been at 37. Our trend is now switched over to positive. The green line has crossed over the red line, but it's still below 20. It's still below the moving average. Our bias is now positive. We've had a number of up days in a row right now, and I'm keeping our momentum at mixed mainly because of volume. The economic reports that came out, we had the weekly MBA mortgage applications index. It came up 2.9%. Purchase applications were up 2%, which translates into down 35% year over year. Refinancing applications were up 5%, which translates to being down 61% year over year. Pending home sales were up 0.8%. They expected it to be down 2.3%. Last time it was up 8.1%. Looking at some Isabel Net charts, this chart really just shows how a lot of money is going into money markets. And maybe you've done this personally. You've had money sitting in a savings account giving you virtually no return at all. You're looking at a money market, maybe through your brokerage or some type of situation that you have access to this. So why not switch your money over to a money market fund? But this just says that the assets that are in money markets are pretty much higher than they've ever been. Now, that could be to get a better rate of return, as I said, but this money could also be used in conjunction with the market. If we really start to see some improvement in the market, that could be money that could come in and buy stocks and help give more support to stocks. This chart is kind of scary. It has a lot of numbers on it, and you're like, what's going on here? I put a red box around what I think is the takeaway from this chart, and it says at the top, when stocks stay above the December low, good things happen. So far, that's been what's happening. We came down, we tested those December lows, and now we're bouncing up off of that, and it tends to be very favorable going forward. Here's another chart showing that there's still a lot of fear out there. People are really having a hard time getting into risky, meaning stocks, against safe assets. They're really looking for safety amidst this uncertainty with the banking situation. Then they also ask, are you more likely to increase or decrease stock exposure over the coming days or weeks? 40% say they're willing to buy more stocks. Then this is still suggesting that the earnings estimates are going up. Now, is that realistic? If we're heading into a recession, we've been seeing a real revision going down with earning estimates, but this says that they should be going back up, and that, if true, could give some support to stocks. They did a poll asking, what is the probability of a recession in the next 12 months? And this was done by Bloomberg. Goldman Sachs is saying there's a 35% chance of a recession, where last time they said there was 25%. This just gives you an idea overall of how people are feeling about things. One thing that we noticed that seems to be improving right now is the small cap underperformance, and I'm keeping a close eye on that. When small caps do underperform, this is not a good thing for the market. The dark blue line shows how the small caps have been going down, and here is the ISM manufacturing, which is turning back up slightly, but has still been headed down overall. So we want to be looking for some small cap improvement if we're going to see a general improvement in the market. These are the expectations of the conference board by looking at current conditions, where they continue to fall overall, suggesting that we may be heading into a recession at some point. This chart just says Fed rate cuts have become more plausible, yet the yield curve inversion has probably overshot. Well, who really knows about that? As I talk about every day, we do have most of the yield curves that we follow remaining inverted, and some of them are even extending that inversion. Looking at the leading indicators, the red line is looking out 4 to 6 months, the blue line is 8 to 12 months, and then the black line is over 12 months. And the 12-month is looking down, where we're seeing a little bit of improvement. It's a little hard to see with this, with the 4 to 6 month and the 8 to 12 month. Then the Real Investment Blog, their latest post, their headline says a Federal Reserve pivot is not bullish. That's what the market's been living for, because of what they say right here. Like Pavlov's dogs, investors buy when they hear a pivot bell ringing. Their conditioning may prove harmful if the past proves prescient. And here's a chart just showing the bearish history of rate cuts. Now, think about this logically. If the Fed is cutting rates, that generally means the economy is slowing down or really having some difficulties, so they have to lower rates to try to stimulate the economy. If the economy is having trouble, that feeds over into companies, and companies feed over into the earnings per share, and if the earnings per share are dropping, that feeds over into the stock market. So there is a little bit of logic going on here. Now, there have been times when the Fed has come in with a pivot and the market skyrocketed. I can think back to late 2018 when they did a pivot and then we really shot up. Also, after the whole COVID plunge, which is kind of its own little thing. Also, we have to take the other side of that, realizing that it doesn't always mean things are getting better if the Fed is either stopping raising interest rates or starting to cut them. going back to 1983, where you look at 10-year real yields. And the interesting part is this green shaded area where interest rates on a real basis, that means that they figured in inflation, have actually gone negative a few times, where then we have the 10-year in orange, and then we have the expectation of inflation over 10 years. Sometimes interest rates have actually gone negative on a real basis, taking into account inflation. They also say, what percentage drawdown should we expect? They're kind of figuring, since we had such an up move in 2020 and 2021, having a bigger drawdown should not necessarily be that much of a surprise. Since the market experienced a decent drawdown during the rate hike cycle during March 2022, might a good chunk of the rate drawdown associated with the rate cut have already occurred? That's an interesting thought. The graph shows the maximum drawdown from the beginning of rate hike cycles. The average drawdown during rate hike cycles is 11.5%. The S&P experienced nearly a 25% drawdown, so maybe they're suggesting that some of the worst is already behind us. We don't know. They're just trying to play out a thesis right here. This shows over on the right-hand side, after the rate cuts, how the market went up over 50%. So if we went up that high, do you think the fact that we're now dropping low should be that surprising? That's what they're trying to put forth in this blog post. They're also suggesting that stocks continue to be overpriced. This is a chart that I show in the weekly video, the CAPE PE ratio. At the bottom it says, in summary, the Federal Reserve is outspoken about its desire to get inflation back down to 2%. If they were to pivot as much and as soon as the market predicts, something has broken. Currently, it would take a severe negative turn to the banking crisis or a rapidly deteriorating economy to justify a pivot, the likes of which the market imply. Then at the end, mind you, something breaking, be it a crisis or a recession, does not bode well for corporate earnings and stock prices. We want to maintain a balance here. Yeah, we like the idea if interest rates are coming down, but at the same time, why are they coming down? Looking at a few charts that I found on Twitter from Tom McClellan, he's a big person into the shifting forward of charts. He took the M2, which is the money supply, divided it by GDP, and then shifted it forward 12 months to try to get some patterns as to what is happening in the market. Well, this ratio has really been dropping off, and if that is true, then we might see a fall off with the S&P 500. Here's another chart based on the University of Michigan Consumer Sentiment Index shifted forward 10 months, where we have the unemployment rate, which is down. This is not inverted, this is actual. The green line has really been going up, meaning that folks are not all that happy about things, even though it has been improving slightly. We're seeing a real wide separation between the two. So are people going to get happy again or become even more pessimistic than they already are? Or is the unemployment rate going to start to go up? And that's kind of what we're trying to see going forward. Then the last chart also inverts the unemployment rate and compares it to the S&P 500 to show that when the employment rate is actually going down, remember this is inverted, that really helps the overall market. If the unemployment rate starts to go back up, could that have a real impact on the market? Then looking at our charts, the Ulster Index continues to drop, showing that fear is coming out of the market as the market's been going up. The VIX has now dropped below 20 on the line chart as well as on the bar chart, and volatility continues to decline. The equity put call ratio, looking at the 5-period simple moving average, after spiking up and coming back down, that does seem to be giving some support to the stock market right now. We want to see if that can continue. Fear is also starting to fall off at this fear gauge that we look at. Fear is also starting to come down with this other fear gauge that we look at. The high beta stocks had been really starting to come down, but they're ticking back up. Are we going to see this group that outperforms the market, either to the upside or to the downside, start to outperform the rest of the market? On a one-day basis, we probably overdid it. Our advanced decline ratio is extreme positive. This is another change with our ADX. Even though the ADX is falling, the green line has now crossed back above the red line, so now we default to positive. The daily chart showing how we're still above this downward sloping trend line. We're above the 200-day moving average, and now we've been able to recapture the 50-period moving average. But look down at the bottom, showing where volume is well below average. And here's a 2-year look at that same chart. Our Arun is pretty much flat after giving us an extreme negative reading and showing some improvement. We're still negative, but it is showing improvement. Looking at the Keltner bands spaced 1, 2, and 3 standard deviations above and below the midpoint, we're recapturing this dash line where we had been at yesterday. We were able to get all the way up to the 1 standard deviation currently. Then this is another chart. I just noticed that during the last year to year and a half of the market, we've been around this 4,000 level a whole lot. So I just drew a red line here at 4,000 showing how we've been going above and below that particular level. The Stochk RSI is starting to get extreme positive, but that could also be showing us good momentum. The Williams percent R is now starting to get extreme positive. The short-term stochastic, extreme positive. Looking better with the intermediate-term stochastic, but starting to get extreme and showing improvement and getting ready to cross above the midpoint is the long-term stochastic. The force index is above 0 and advancing. That's short-term positive. We're above the 20-period moving averages. That's positive. We were able to get back above the 50-period simple moving average. That's positive, more intermediate term. And we're well above the 100-period moving averages. Our moving average tree shows us starting to come out of the upside of the tree. The Swindlen Trading Oscillator, based on price and volume, are advancing and above 0. That's positive. All of our oscillators have now switched over to positive. The parabolic SAR is still positive with the dots underneath. The Chaikin oscillator, after showing some weakness, is now turning back up above 0. That's positive. The vortex is seeing the green line crossing above the red line. That's also positive. The ultimate oscillator crossed back above 50 and showing improvement. That's positive. The Sean trend meter is now coming into this green area, which suggests things are more positive. We're looking better with our 20, 50, and 200 period moving averages. They're both going up and showing improvement. The CCI 14 is extreme and the CCI 20 is just barely extreme, which again could be suggesting good momentum. The RSI is above 50 with both the 14 period and the 9 period and showing improvement. That's more positive. The ratio between the S&P and the utilities, this hasn't really broke out yet. It's showing a little bit of improvement after chopping sideways, but we want to see this really start to go up. So this is a little bit of a warning sign, and this will be a chart that we're keeping an eye on if we continue to go higher. Our Ichimoku cloud, we're right in the middle of the green cloud right now. We want to see if we can break out above that. The PMO is now positive. It's crossed, where a few days before that we saw it cross based on price and volume. Our PMO study starting to get extreme positive with the PMOs inside the S&P that are rising. We're seeing an improvement with the buy signals, and we're starting to turn up with those PMOs that are above 0. Looking at our BPI longer term chart, we're starting to bounce up out of that and showing a positive divergence. The NYSE broader measure of the BPI is also showing some improvement. The Chaikin money flow also looking more positive. The balance of power is above the dashed line and advancing. That's positive. Starting to see some new blue bars here with the TTM squeeze. That's positive. We're still more or less neutral with the go, no go. We're getting a little further away from the 200-day simple moving average. Our short-term fib levels, we closed above this 4,004 level. Looking at a longer-term fib chart, we're above the 4,000 level now. And longer term, we closed above the 4,020 level. We closed at 4,027, and this resistance level is at 4,020. And one thing I had been pointing out, it looked positive in the background. Well, this could still be positive. You can take this two ways. We're starting to see the bigger stocks underperform the rest of the market. That could be negative, but also that could be positive by meaning that more stocks are now starting to participate in things with the upside movement that we're seeing. The Elder Impulse system for the S&P is positive. McClellan oscillator starting to get extreme positive, but still has more room to go. And our broader measure, McClellan oscillator, has crossed above 0, so that's turned positive. The summation index based on price and volume have turned up and are positive. The new highs, new lows starting to look better with our 5 period and turning up with our 10 period. This is another warning sign. The advanced decline line based on price is above the moving average. We haven't quite crossed above the moving average yet based on volume. This could be seen as a negative divergence. Our advanced decline ratio, short and longer term, is showing a lot of improvement. Accumulation distribution above an advancing moving average, that's positive. where volume is dropping off. That is a warning sign. Then some other charts that I come across that are not turning positive yet. We still have the Renko negative with red blocks. And the 3-line break still has red bars. Another positive side, we're getting above the 0 line with our boom indicator. This measures the 50 and 200 period moving averages and how far price is above or below those moving averages. When we cross above 0, which we had been below, that is turning more positive. Then longer term, we're seeing our 150 and 200 period moving averages starting to cross above the midpoint. That's turning positive longer term. The financial ratio saw a little bit of a bounce. The bank ETF was up almost 1.5%. The regional banks were up over 2%. The other regional ETF was up over 1%. The ratio between regional banking and the financial sector did go down just a little bit. Another thing to keep an eye on. And First Republic was up 5.63% after just getting hammered. I may not show this chart anymore after today unless more news breaks about this specific bank, but we are keeping an eye on the banking sectors. The Dow was able to get back above its 200-day moving average and stay above that. We're also above this pivot level. The diamonds are positive. The NASDAQ also broke back above this pivot level. And the NASDAQ 100 is breaking out above the pivot level. The Qs are now back to positive. The NASDAQ 100, we're getting close to this 12,868 level. We're now at 12,846. So we're about 22 points away from that resistance level that stalled things out previously. The microcaps were up over 1% after setting a recent new 52-week low. The small caps showing some improvement. Here's the Russell 2000 small caps. We're seeing the MACD cross positive. We're just under 50, but looking better with the RSI. The small caps are still neutral, and the small cap ratio to the S&P showing a little bit of improvement, but still really underperforming. The mid caps were able to get back above their 200-day moving average and have now turned positive with the Elder Impulse system. Watching the home builders too, we could be seeing some kind of divergence here. The S&P is now starting to go back up. The home builder ETF has been advancing, but the ratio's been breaking down a little bit, so our relationship is starting to wane a bit. If we see weakness in the home builders while the S&P is going up, that's going to be a big warning sign, and that's why we look at this chart. That would be a negative divergence. The Copic curve gave a recent buy signal, as did the Pring bottom fisher. Bond yields were up just a little bit, virtually unchanged, and bond prices were also virtually unchanged. The long-term trend, this could be showing some improvement. The MACD is turning up ever so slightly. You almost need a magnifying glass to see it, but as long as we're above this moving average, and then if we can improve from here, that would help support the idea that this breakout above the trend line was not a fake out. Now, one solid down day and we close below the trend line, all that's out of the water. An update of our possible positive scenarios showing some improvement with price and volume when you look at our 19-day exponential moving average of the advanced decline ratio. This is also showing improvement, the 10-day average of the S&P 500 highs minus the lows starting to cross above 0. This is a little bit of a warning sign. When we take a 5-period moving average of the highs and the lows, we're still negative, even though we're showing some improvement. We want to see this. This would be a broader measure of strength or weakness, depending if we're above or below 0. Looking at our ratios, the Qs to the S&P turned back up slightly. Still not really seeing all that much strength with discretionary, but the large cap growth is outperforming large cap value. Looking at our growth value ratios, large caps turning up. Not a lot of turning up with the mid caps or the small caps. We'll be keeping an eye on this one. The 50-period exponential moving average of the new highs, new lows is still below 0, so that's negative. But if you look at the indicator, we continue to be above 0. The longer we're above 0, the more likely that red line is going to go back above 0. So we'll be keeping an eye on this too. The 2-year Treasury yield, after spiking and coming back down, that could be giving some support to the market that we're seeing right now. And then our staples to S&P 500 ratio, it did tick down a little bit. We're looking to see if one of these spikes either goes back up and creates a new spike, or if we can work off of this previous high spike But until we see that happening, we're still working off of this other high spike. This is way back at the beginning of the year. So this spike, even though it looks impressive and gave a little bit of support to the rally that we saw early in 2023, we're going to have to start looking at what's happening more currently. What's our outlook for Thursday? Thursday and Friday are the last trading days of the week, month, and quarter. That could produce an increase of volume that we've been looking for. So we'll be looking to see at any window dressing, if any selling is going to go into this or buying is going to go into this. But that should help improve the volume. The technicals are positive, but then I try to point out some of these warning signs that we're seeing. We have weekly jobless claims coming out. We have the fourth quarter GDP, the third estimate. This is the third time we've seen this report. And unless it's massively different than what we've already seen, it's really not a big market mover. The whole list of geopolitical events, of course, we're wondering if more banking information is going to come out. The inflation and interest rate scenario, that's always at the background of everything that continues to happen. We don't have any Fed speeches for Thursday. There was one Tuesday and Wednesday, which made for some interesting comments. There's going to be a couple of speeches on Friday, but they're after the market closes. Then our Stock Traders Almanac for March 30th. We tend to be more positive. The Dow's up 66.7% of the time. The S&P is more neutral to positive, being up 57.1% of the time. And the NASDAQ is also positive, being up 66.7% of the time. Then these positive backdrops. Typically, March is up more than it's down. We have the January trifecta, which gave us a 3-0 score. The Santa Claus rally gave us 1. The first 5 trading days of January were up. That gave us a score of 2. The January barometer, the entire month was positive, so that gave us a score of 3. When that happens, good things tend to happen, even though we've been having some difficult times. And the market also likes that we're split between Democrat and Republican in different branches of the government. We're going into the 22nd trading day of March. The green line shows that we are down just a little bit, and then you can also see some more weakness going into the end of the month. We're supposed to be in this pre-election after midterm bear, this gray area, which could give some really good support to stocks, but we're not really seeing that. And then we're also supposed to be in this really nice sweet spot now, but we haven't seen a lot of that this year. Looking at our different scenarios, can't really go with the down one now because things are turning a lot more positive. But we can't go with the up one either because we're still not really trending, even though things are improving. So we continue to go with the sideways trend. Even though the ADX is weakening, it's below 20, but now it's switched back over to positive. Our conclusion, the S&P is improving a lot and actually turning more positive, especially in the short term and intermediate term. We're still positive in the long term because we're above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day. If you're into baseball, you're probably really excited about the start of the regular season. I know I am. I'll be following the Seattle Mariners as much as possible and hoping that they just play some good baseball this year. So have a great day, and I will talk to you in the next video.